In San Francisco, this is Bloomberg Technology. Coming up in the next hour, start the presses. That's what Mark Zuckerberg is hoping Facebook's News tab will do for publishers that have been hit hardest by the advent of the internet and Facebook. Plus, prime pains, why Amazon's one-day shipping is causing some hurt now, but will benefit the company in the long run. And Intel gave a fourth quarter outlook that was seen as strong, pushing shares of the company higher on Friday. We bring you our conversation with CEO Bob Swan. But first, to our top story. So after years of critics piling on Facebook, blaming it for altering the news industry, the social network is trying to make nice. On Friday, Facebook launched its News tab. It will feature articles chosen partly by employees, and the company says it will be free from editorial guidance from Facebook. There are more than 200 publishers on board, some being paid more than $1 million for their involvement. Speaking at the Paley Center in New York, CEO Mark Zuckerberg outlined another way for news organizations to make money.
You can run your own ads and get 100% of the revenue, or you can use our ad network, which we have obviously a lot of engineers and people working on trying to build really advanced technology for this. And there we give the vast majority of the revenue to the publishers. But I think what we've really unlocked here is a business model where it makes sense for both parties.
To discuss in Washington, it is Danielle Coffey, Senior Vice President of News Media Alliance. And in studio with me, it's Bloomberg's Kurt Wagner, who covers Facebook for us. So, Kurt, give me your first thoughts on the News tab.
Well, this is like the 10th time that Facebook has attempted to make nice with publishers. There's been a bunch of different things between live video and Facebook Watch and Facebook Instant Articles. All these efforts over the years to try and make publishers feel like they're actually getting something in return and not just putting their stuff on Facebook for free. So I think, we heard a little bit from Mark Zuckerberg there about the business. I think there are two potential lines of revenue here, right? Facebook is just straight up paying some of these publishers, plus on top of that, it sounds like they have a chance to make some money from advertising. I think that's better than some of the efforts they've made in the past, but you have to understand a lot of these publishers have been burned multiple times in the years before, and so everyone will kind of look at this through a little bit of a skeptical lens.
And Danielle, from your take, being involved in the news media, what are your thoughts?
So we view this as a step in the right direction in valuing the quality news that has fueled their ecosystem and has allowed them to flourish and make a tremendous amount of money off of. But is this adequate enough to sustain the news industry into the future? No, we don't believe that it is. I don't even think Facebook believes that it is. But it is a step in the right direction. It just doesn't cover all the communities and the local coverage that are necessary to what becomes a national story and the investment that goes into local journalism to cover communities. It's a step in the right direction, but it does fall short.
So a step in the right direction, but Kurt, talk to me as you cover Facebook. How does this help Facebook besides maybe helping its image? Does it help the bottom line?
I don't really think so, other than it keeps publishers kind of continuing to have a relationship with the network. And so, if you see the Bloombergs and Wall Street Journals and New York Timeses of the world leave Facebook because they no longer see value there, I think that could hurt the bottom line. So in some ways, this might just be more of a preventative thing. It's certainly a goodwill gesture, right? Like we hear you, we believe in journalism, we believe in the mission, and as a result, we want to help you out. I don't see an immediate financial benefit for Facebook here, and in some ways that actually is probably a good thing.
Right. Well, and we should, in full disclosure, note that Bloomberg News is a publisher in Facebook's News tab. So for full disclosure, Bloomberg News is a publisher as well in this News tab that they are announcing on Friday. So Danielle, let me bring you in here again. How much of this really does help the image of the company? Because frankly, they need it right now.
Sure. I mean, there was no secret that you were just talking about the bottom line and whether this helps Facebook. I mean, of course it does. It sustains our ecosystem, whether it's the content that people read and consume or the data based on our readers that they gather off of us. And so for the long-term ecosystem to be able to disseminate quality information, of course, that's essential to their current and future business model. When they proposed the terms that they did, it was in a way that you would never conduct a normal negotiation. So when it's take it or leave it, and it's done in secret, and the publishers can't talk to one another, that's not a traditional, that's not a functioning business model. So it does serve their bottom line, and it serves their ecosystem. But what we're looking for is how it comes back to us, the originators of the content.
Well, and there's a lot of national organizations participating in this, and Zuckerberg did talk about how it may or may not impact some of the local coverage that has been hit the hardest. Take a listen to what he had to say.
Local papers have probably been hit the hardest. Also, one of the other products that we're working on is we are also building a separate tab that we call Today, including local news in there, and forming a financial partnership around that is one of the things that we hope to do. And earlier in this year, we also announced a $300 million commitment to journalism and helping a number of publishers, but a special focus on local news. I don't pretend that any of these steps by themselves are going to be enough. I don't think that we as one company are going to be able to solve this issue.
Danielle, your thoughts on if it goes far enough to help some of the local coverage that's been hit the hardest?
So the Today In, it's difficult to determine whether or not the traffic that comes in is specific to the Today In or not, but the monetization that you get from that, from the advertising business model is pennies. We only get a portion of what comes to us, again, because of the broken advertising ecosystem that I think the DOJ, the House, and others are looking into. But as far as what we're experiencing is that we're not getting an adequate return because the traffic that generates the advertising dollars isn't enough to sustain the news content that we generate. So no, it doesn't help the local communities and coverage that we do with local newspapers that need to be able to get a sufficient return on our investment in that coverage. And then with the license, with the new news tab, it didn't cover everybody. It covered I think the top 10 metropolitan markets, the national covers, and while we're happy about that, and I said it's a step in the right direction, is it covering our local communities where they need it the most? No, it's not.
Danielle Coffey at the News Media Alliance and Bloomberg's Kurt Wagner, thank you both for joining. Now we have some breaking news. PG&E is telling 850,000 customers that they may lose power. This comes after California Governor Gavin Newsom declared a state of emergency for the counties of Sonoma and Los Angeles because of the Kincade and Tick fires. And coming up, you can't steal what isn't there. That's the approach a VGS is taking to protect your data. We hear from the CEO just how they can achieve that. It's next. This is Bloomberg. Securing customer data online is a hot topic across the globe, and one company says it has a unique approach to handling sensitive information. Very Good Security, aka VGS, lets companies access such information without ever needing to hold on to that data themselves. They've just secured a $35 million Series B funding round led by Goldman Sachs Merchant Banking Division. For more, I want to bring in the CEO and co-founder of VGS, that is Mahmoud Abdelkader. So there we go. Talk to me about the funding. Congratulations. What are you using the money for?
Thanks so much, Taylor. It's a pleasure to be here. So we're going to use we're very excited to partner with Goldman. We're very fortunate for them to back our vision. Both Marshall and I are very thankful. But really, the big idea here is to completely democratize best-in-class data security and privacy for companies of all sizes. And so the funding is going to follow a Silicon Valley traditional growth company here, where we're going to be investing obviously in R&D, but go-to-market functions as well as hiring, sales, marketing, and really expanding on our growth that's happening lately.
And huge investors, Andreessen Horowitz, Goldman Sachs, good big name backers. Why are they interested in you?
So they see a shift in the market coming. They see a different approach that Very Good Security is taking today. One of the biggest issues that we see is that previously you had to effectively police data going in and out of data centers. And that approach worked before, 10 years ago, 15 years ago, but now data, which we called an asset before, is more increasingly becoming a liability. And so when they see this shift in the market happening, how do you catch up with data, and how do you advance and build basically a solution that can, catch the market as it increasingly has data proliferating all over the place?
And is this purely a data privacy issue, or have some of the investors, namely Goldman Sachs, because they've talked a lot about digital currencies and tokenization, also is this them making a play in that area as well?
Yeah, we're very excited to partner with Goldman, and they're obviously a very respectable partner. I can't comment on any specific initiatives, but what I can say is that there is a variety of good reasons why they took an interest in us.
Okay, I'll have to leave it at that. Talk to me. You mentioned and started out this conversation saying you're a classic Silicon Valley growth company. Talk to me about, though, then the valuation, and if you're free cash flow positive, and when you can expect to see some profitability.
Yeah, so we can be profitable if we choose to, but we purposely do not. What we're trying to do with this funding is accelerate our growth. And ultimately, when we took this funding, we wanted to just move faster than the market would have wanted us to move fast if we've just been by ourselves, right? And so the idea here is that next year or the year after that, we could be profitable, but what happens if you were able to get to that position today? So the reason we took that money is to just accelerate 2 years, 3 years of our timeline. So we're not too worried about cash flow and free cash flow and cash flow positivity. We can be, but what we want to do is capture the market today.
Well, and you're at least being able to see that path to profitability. Mahmoud Abdelkader, the CEO of VGS, thank you for joining.
Thank you so much for having us.
And shares of Amazon are still in the red following an earnings report that showed increased spending in order to get one-day packages out the door. That is something that the CFO, Brian Olsfonski, tried to reassure investors on their earnings call Thursday.
On the cost side, yeah, it's going to be the route density and other things will improve over time and get our cost structure down. But for now, there's certainly some startup pain in adding new capacity.
Brad, talk to me about this. It was the profit decline that everyone is worried about, but are you shrugging it off because eventually every time they invest, revenue eventually follows?
Well, Taylor, I think it's safe to say that the market's kind of shrugging it off. I mean, the stock today is down, I think, 1.8%, well above the market lows after trading yesterday, where it was down like 7%. This is a movie that a lot of these long-term Amazon investors have seen before, and they like it. It's their happy place, which is a reacceleration of revenue, top-line growth. That North American retail segment bounced back up to 24%. People were worried that Amazon retail was slowing down, and now it seems like next day delivery has reaccelerated it. And yes, the profit miss. Well, Amazon didn't have profits for years and years, and so that's nothing to these long-term investors and analysts. As to whether it pays off, I mean, it looks like next day shipping, to my surprise, I didn't think next day was all that different than 2-day shipping, but so many companies like Target and Walmart have kind of caught up to 2-day shipping, so Amazon's trying to go further and kind of redig its competitive moat around its main business.
Brad, if one-day shipping were so good, why did they revise or come in lower than expected on next quarter's crucial holiday sales on the top line?
I think like the history, frankly, on this revenue guidance is they're always very conservative. I don't put much credence in that. I think the top line surprise this quarter. We'll see, what it does on the holidays. They pointed to a couple things like the smaller than average number of days between Thanksgiving and Christmas, and how some holidays abroad, including Diwali in India, some of that went into the third quarter. We'll see. It kind of. I think the pattern so far is that next day shipping does make a difference. We saw unit growth. My colleague Shira Ovide was wondering for so long, why is unit growth at Amazon slowing down? And now it bounced back up by several percentage points. So the evidence so far is that next day shipping does move the needle, but we'll see.
Brad, you're also going to the Sooner Than You Think conference, and I'm not cool enough to call it by its acronym STYT. You're out there next week. What are you looking for?
Yeah, so we have this conference 3 times a year, once in Asia, once in Europe, and next week on Wednesday it's in Brooklyn. You know, we try to take a different approach. Instead of the same executives from the same companies who say nothing, we're talking about solutions to this moment that tech finds itself in. We have the Attorney General of Ohio to talk about the state's antitrust investigation into the big tech companies. We have panels on privacy-focused design and security inside companies. We have the great design ethicist from Google, Tristan Harris, to talk about how we can have a more productive relationship with technology. And your colleague Carolyn is going to be co-hosting with me, and we've designed a deep fake video involving her that she's going to kind of get into deep fakes and the impact that they're going to have on our culture going forward.
Brad, this is also notable because it's in Brooklyn and not in San Jose. It's not in San Francisco. It's not in Silicon Valley. In all of your years of covering tech, have you started to see this shift? Are we losing a little bit of the tech in SF and it's shifting over to the East Coast?
Well, I mean, this was actually more about kind of counter-programming. There are plenty of conferences in California. One could probably make a life out of just going to them. So we thought we'd experiment with an event on the East Coast. And in fact, we've got the CEO of the Nets, David Levy, coming to talk to us about what's going on in Brooklyn. And of course, the NBA's interesting relationship with one of its most important markets, China. But I mean, look, San Francisco and Silicon Valley is still the center of the tech universe. If there is a threat, it's in Asia and Beijing and Shenzhen. But look, tech is growing and it's lifting a lot of boats, and I think it is more dispersed, perhaps across many cities, including New York, including Washington D.C., than it has been historically.
Well, as long as it's in San Francisco, we can keep our jobs another day. That was Bloomberg Technology Senior Executive Editor Brad Stone. Thanks for joining. And coming up, gains for Intel shares on Friday after the company gave an upbeat sales and profit forecast. We hear from the company's CEO, Bob Swan, next. This is Bloomberg. Intel gave an upbeat sales and profit forecast for the fourth quarter, citing improved demand for semiconductors that power cloud computing data centers. The company shrugged off concerns that the trade dispute between the U.S. and China is hurting the industry. Bloomberg's Paul Allen and Sherry Ann spoke with Intel CEO Bob Swan earlier. Take a listen.
We outperformed by about $1.2 billion in the quarter, and we expect about $200 million of that was pull-ins from the fourth quarter in light of the anxiety about availability to products. So not a whole lot of it, but some of it. But despite that, we did take up our fourth quarter outlook as well.
Now, back in June, you said you were reviewing your supply chain, and this, of course, was in the context of the trade disputes and the U.S. entities lists. I'm just wondering if you can share any insights from that review. Are you making any changes?
Well, I think for our customer base, we have China is a large market for us in terms of customers for China consumption, but also for global OEMs that have more of their assembly and test operations in China. So what we're saying is, in light of the debates around tariffs, we're trying to work with our customers to ensure that they can get their product most effectively by leveraging our global supply chain to diminish the impact that tariffs could have on their supply for global markets. So we have a wonderful global supply chain, and we work closely with our customers to deal with the dynamics we're wrestling with. I would say that we're encouraged that China and U.S. are talking, because we're a strong believer in global trade. We don't find tariffs to be a constructive mechanism for global trade, so we're very encouraged that the two sides are back at the table. In the meantime, we'll leverage our global supply chain competencies to mitigate the impact on our customers around the world.
What are your shipments to Huawei looking like? Of course, they have been blacklisted by the U.S.
We don't really get into talking about specific customer demand. I would say Huawei has been an important partner and customer of ours over the years, and we continue to see them to be an important customer going forward. But at the same time, we have to adjust and adapt to the laws in the markets in which we serve. So we'll continue to serve them to the extent we're allowed to under the current entity list.
Are you getting those temporary waivers and licenses to supply to Huawei at the moment?
I think the industry, the semiconductor industry, and clearly Intel, we have put applications in to get licenses to ship, but we have not heard back yet. We hope to hear sometime soon, but we have not heard back yet.
That was Intel CEO Bob Swan. And NetEase CEO William Ding says the Chinese internet company is aiming to take its popular music streaming business public after its education platform, Youdao's, debuted Friday. He spoke to us from the New York Stock Exchange.
At a time when the management team is mature and the company has a leading advantage on the market, then we can make the decision whether or not it should go public.
Now, despite the trade tension and talks on stricter rules on Chinese companies, Youdao still chose to go public in the U.S., following the footsteps of its parent, NetEase, which went public at NASDAQ in 2000. Bloomberg caught up with Youdao CEO following the company's debut on the New York Stock Exchange.
Our parent company, NetEase, has always been a U.S.-listed company, and we like the U.S. stock market because they've treated us well, and NetEase has returned a lot of return for U.S. and Chinese investors all over the world. And for us, we think, well, at least we are not doing trade-related business. So, and education, I would expect it to be a very good way to kind of connecting the U.S. and Chinese people. Yeah.
And one of my last questions. So what's your reaction to the opening price is about 20% lower than the IPO price? Do you think investors are pricing in the right value?
Well, I think we operate for the long term. So getting to IPO is an exciting step for us, and it's a very good way for us to attract better talent, to be a more respected company. We think it is the right move, and we are very confident in our plan. So we think this is a very new starting point.
That was the Youdao CEO at the New York Stock Exchange. And coming up, we recap this week's biggest stories in tech: Amazon's disappointing fourth quarter forecast, Zuckerberg defending Libra on Capitol Hill, and of course, the downward spiral that is WeWork's valuation. All of that is next. This is Bloomberg. Bloomberg Technology. I'm Taylor Riggs in San Francisco. Now to our weekly roundup of the top stories in tech. This week started with the quarterly earnings bonanza. Amazon shares rebounded on Friday after the e-commerce company reported its first quarterly drop in profit since early 2017. The company also reported a miss for next quarter's guidance as well. To discuss, I'm joined in New York in New York, it is Bloomberg Opinion, Shira Ovide, and here in San Francisco with me, it is Bloomberg Technology Executive Editor Tom Giles. I can't remember what city I'm in. Shira, let me start with you over there in New York. You had a pretty good piece talking about how the one bright spot of Amazon, which was its cloud business, is now starting to show signs of cracks. Why?
Yeah, look, I don't want to get hyperventilated about one kind of okay quarter, a couple of okay quarters actually, but remember that Amazon Web Services is extremely important to Amazon both financially and strategically. So even though it has about 1/5 or so of the revenue of Amazon's e-commerce operations, it generates more operating profit than all of them, than the e-commerce businesses. So that shows you that Amazon needs AWS to work in order to generate total profits for the company. And in this third quarter, what you saw was both the slowest quarterly growth rate for AWS since Amazon started breaking out those results 5 years ago, and a profit margin that was, at least by Amazon standards, by AWS standards, not great. So that combination was a little bit worrying.
You know, Tom, we look at the profit so much because the company heavily invests, but then analysts came out and really shrugged it off. They're defending the stock. Is this because every time you see big investment, eventually it leads to growth?
That's exactly what happens with Bezos. He's willing to spend heavily. We were doing the math on this. The analysts' expectations right now, the target price for the stock is about 24% higher than where it closed today. So analysts are out there telling their clients, buy these shares, even at these near record levels for Amazon. Despite the concerns about profitability, I think Shira raises some really good points. People are falling over themselves to recommend the stock, and the belief is, yes, it costs a lot to do that one-day delivery, but it's going to pay off because people want their stuff and they want it quickly.
And Shira, we also go over to the earnings of Twitter, and we saw that revenue fell in part because they stopped a glitch that abused customers' data and their privacy. Where are they going to make up that revenue?
And revenue didn't fall. It was just sort of lower than people, including Twitter, expected, both in the third quarter and the forecast for the fourth quarter. So, yeah, I agree. I thought it was actually very concerning, the reasons for the revenue decline, which is basically Twitter fixed what it called kind of errors in a few of its products, including settings, where basically it was ignoring people's privacy preferences. And as a result, it turned off some kinds of ad targeting that it had previously turned on, again, in violation of people's trust. And as a result, the growth fell short of the company's own forecast, both in the quarter and on an ongoing basis. And to me, this raises questions about just the health of Twitter's advertising business. If basically it can have a revenue growth shortfall because of a couple of setting changes that shouldn't have been there in the first place, then maybe this ad business is not on such solid footing after all.
I want to switch to another story outside of earnings where we talk about Facebook and Libra. Mark Zuckerberg was on Capitol Hill on Wednesday, and one of the first things he said before talking about Libra was his take on political ads. And he's come out and said, we are not going to moderate. We believe in free speech. It's up to the politicians to determine what is right or wrong. Tom, in all of your years of covering this, is that the right approach?
Well, not if you're Alexandria Ocasio-Cortez, right? I mean, she really took him to task for this, and that was one of the most interesting and memorable interchanges of the several hours that he spent being questioned by lawmakers, was her going into very specific instances of, well, what if I buy an ad that says that the Republicans were backing the Green Deal? What if I buy an ad that says this? And he basically said, this is something that we would not bar you from doing. He's really going to be called to task for that, especially given what happened in 2016 when there was so much disinformation that was spread on the Facebook platform. This is going to come back to haunt them time and time again. And in my view, it's just a matter of time before you're going to have some backtracking and some more mea culpas from Facebook on this one.
Shira, as we also take a look at that testimony and transition over to Libra, did we learn anything new about Libra this week?
I think what we learned this week is that Libra is not going to happen, or at least not anytime in the foreseeable future. You know, Zuckerberg, in his opening statement, said that they're not going to move ahead with Libra unless and until there's regulatory approval in the United States. I do not envision a scenario where that happens again in the foreseeable future, and so maybe we should just all stop thinking about Libra for the time being.
Dead on arrival? Should we stop thinking about it?
I think there's going to be a continual debate over there's going to be discussion over, is this the right thing to do? What is Facebook doing it for? Why are they putting so much effort behind it? I do think it gets put on the back burner, but I don't think the discussion is going to go away. And I think people are going to continue to debate whether it makes sense for me, like as an Uber or a Lyft or a Spotify, to be part of this if and when it does get off the ground.
Well, we all know it would not be a news day if we didn't talk about WeWork and SoftBank. So Shira, you have yet another scathing article on WeWork and SoftBank. Walk me through why it could still get worse for WeWork.
Yeah, this is just the story that keeps getting wilder and weirder. So look, the thing that I am a little bit concerned about for WeWork is it got this bailout, this kind of financial emergency, basically what's a loan, a loan from SoftBank or arranged by SoftBank for $5 billion. I wonder how much time that buys this company. So remember that as of June 30th, they had $2.5 billion worth of cash on the books. That seemed like it was going to be enough money to carry them through for a while. And then all of a sudden, the IPO didn't happen, and it emerged that this company was basically going to shut its doors and run out of money in weeks if it didn't get more cash. And so I just wondered, what is the real kind of cash needs of this business, particularly now that they're going to, we think, lay off a bunch of people, pay them severance, and so on. How much time does $5 billion really buy this company? The other issue is that they have signed leases, committed themselves to making $47 billion in lease payments for, again, a company that bleeds cash. So those two are pretty big concerns, both the rate of money that they've been going through and the amount of money that they are committed to paying in future years.
And Tom, does SoftBank look financially savvy here, or are they throwing bad money at more bad money?
They have little choice. They are so deeply in on WeWork right now, you can't just pull the plug because all of what you have at stake is at risk. We've also talked to people familiar with the matter, reported yesterday. I think you probably talked about it here. We're looking at a write-down for them of at least $5 billion. We'll get more visibility into that in the coming days when SoftBank reports. A lot of scrutiny right now into SoftBank's investments, its attempt to raise Vision Fund 2, and are they good at making bets? And a couple of their bets right now, Uber and WeWork, not looking super smart.
Well, and like you said, that $5 billion write-down could really just be the beginning. That was Bloomberg Technology's Tom Giles and Shira Ovide of Bloomberg Opinion. Thank you both. Now, sticking with WeWork, the company has investors thinking about the profit roadmap for private and public companies alike. But one activist investor says Box is a great example of potential and nothing like WeWork.
The WeWork issue has to do with a lot of leverage and contingent liabilities and other aspects of that business. This is still a good business. It's a well-capitalized business. This is a very healthy company with growth. It's growing a little slower than it used to be growing, but it's still a growing business. And although the profit margins aren't yet where we think they can be, it actually is now a slightly profitable company. So yes, from our standpoint, we think it should be more profitable. As I just talked about at this conference, we think there's a real opportunity to probably both reinvigorate growth as well as to balance that with improved profitability, and Box has that opportunity. We're excited about it. We think the product is really good. Gartner and Forrester rated very highly. It's cloud content management sharing and a terrific company, but it could be worth more.
That was Starboard Value CEO Jeff Smith. And coming up, we hear from BBG Ventures founder Susan Lin about the latest developments in big tech antitrust. Plus, the former president of ABC Entertainment gives us her thoughts on the upcoming streaming wars. This is Bloomberg. Let's take a look at the top tech calls. So shares of NVIDIA closed higher Friday after RBC Capital Markets raised the price target to a street high view of $251 from $217. The analyst said the chipmaker was the best large cap name to own at this time. The analyst pointed to Intel's quarterly results, which saw strong growth in data center products. The analyst said NVIDIA would be a gainer on that news. And speaking of Intel, Credit Suisse raised the price target on Intel to 65 from 58, saying gross margins were the only blemish in the earnings report. The analyst said the results and outlook provide more positives than negatives. And ahead of earnings on Monday, analysts at BMO raised Alphabet's price target to $12.45 from $12.25 a share. Earlier in the week, Credit Suisse raised the price target to a street high of $1,700 a share, saying the release of products in the last few years are driving strong growth of search and YouTube. And those were a look at the top tech calls. And now for our conversation with Susan Lin, the founder of BBG Ventures and former ABC Entertainment president. Bloomberg Businessweek's Carol Massel sat down with Lin for a wide-ranging conversation on the upcoming streaming wars, big tech antitrust, and investing in female-founded startups. Take a listen.
I do believe that there is too much power in too few platforms at this moment, and that's always dangerous. So whether they get regulated, whether they get broken up, that's for other people to decide, but I don't think you can leave things the way they are, where a single platform like Facebook has the power that it does.
BBG Ventures, are you finding all the opportunities you want? I mean, we talked before we got started that there's so much capital out there, whether it's private equity, family wealth offices, venture capital. Are you finding enough opportunities? Because I feel like there's a lot of money chasing the same thing.
We absolutely are. We've seen 5,000 companies with a female founder since we launched BBG Ventures 5 years ago.
And this is what you do. If you're making an investment, there has to be at least one female founder.
That's exactly
Love
right.
That.
Yeah. And we do that not to be a do-good organization, but because we think there's a real competitive advantage to having a founder who intuitively understands that end user. Women are the dominant consumer. We're responsible for 85% of all consumer purchases. So in all likelihood, if you are building a consumer product or you're building a consumer service, women are going to be the early adopters. They're going to be the people who determine whether or not you scale. And so we saw both an opportunity because the rest of the venture capital world was focused on something else. We saw a big opportunity to invest in the best of these female founders.
I'd love to hear you say that. I know you've also been on corporate boards, are on corporate boards. I think it's getting a little bit better in terms of female representation. What do we need to do to get it much, much better? Where it's really parity, and there is, and when I think about it, it should be diverse on all levels.
Absolutely.
So
no question.
What does it take to get there?
So,
because we've been having this conversation for a long time.
Yeah, absolutely. In my world now, the venture capital world, I think that it takes probably 5 to 10 female-founded companies going public, and maybe 5 to 10 exiting as unicorns, for there to be a major shift. We're already seeing a number of storied old boys club VCs bring on their first female partner, and it's all because of FOMO, right? It's because they fear they're going to miss the next wave of big successful companies. So you have to have somebody on your team, on your investing team, who has those networks, who knows those women, and who can make sure that your firm gets a chance to at least compete to invest. That's what's going to change it.
One last question. In terms of investing, you make investments, and I'm curious, is the end game still taking companies public? Because we've seen what an interesting year with WeWork and disappointments over IPOs. What is the ultimate end game, or does that not have to be it anymore? Or will it not be that anymore?
I think that more companies end up getting sold than go public. And that's always been the case. I do think there are a number of female-founded companies out there that will go public during the next, let's call it 2 years, 3 years, that are on that trajectory, that are preparing themselves for it, and that are trying not to make the same mistakes. So the real issue for the companies that have gone public and have either failed or
not made it there.
Yes, exactly.
Yeah.
Is that they were focused on growth over everything else. And they went public still losing billions of dollars, in some cases billions of dollars a quarter.
Right.
And the public markets just said, we don't like this. So there was clearly a big disconnect between what the private markets value right now and what public markets are looking for. I think the female founders I've seen out there, they're watching this very closely. And so are every VC.
I bet.
And I do think that there are lessons that have been learned that you have to take seriously more than just, X% year-over-year growth. You really have to be able to show that there's a business model here that can be successful, even if you're not profitable right now, that there's a path to profitability that is very, very clear.
That was Susan Lin of BBG Ventures and Bloomberg Businessweek's Carol Master. And coming up, private companies are tapped to create space habitats once the International Space Station retires. We explore the feat by one Boston-based company. That's next. This is Bloomberg. Over the past few decades, the International Space Station has allowed astronauts to live, work, and conduct research in microgravity. But with the station's planned retirement by 2030, private companies are being asked to create the next generation of space habitat. AI Space Factory, it's an architecture firm in Boston, proposes an idea to send 3D printing robots to Mars, which can then harvest the materials found on the site to build the next generation of space habitats on Mars. It's technology, it's on the cutting edge.
We will return American astronauts to the moon, not only to leave behind footprints and flags, but to build the foundation we need to send Americans to Mars and beyond.
This proposed mission, along with SpaceX's own ambition to reach a red planet, has opened up a longer-term market. And some companies are already thinking beyond orbiting habitats like space stations to actually building on the surface of other planets.
I was working in a firm designing skyscrapers, and I saw Elon, and he landed his Falcon X rocket in the middle of the ocean, and that for me was a trigger. I thought, wow, this could actually happen. And it's always been my dream to put a building on the moon or Mars. And if he's going at the pace he's going, it could definitely happen within my lifetime, and I want to be the one to build it.
In this warehouse, alongside startups from across the US, architecture firm AI Space Factory are refining the production of Marsha, a 4-story structure they created for a NASA competition to design the next generation of space habitats on Mars.
When we started designing our Mars habitat, Marsha, I think we looked at everything that had been done already and kind of tossed that aside. But what we were given was a set of guidelines from NASA. They think the best way to build a habitat on Mars or the moon is to use what they call in situ resource utilization. So use the materials that are there. If you've seen sci-fi movies, you might see like glass and steel domes on distant planets, but the reality is to ship that kind of material to the moon or Mars would be so exorbitantly expensive you would never be able to build in the first place. So the idea is to send a 3D printing robot which can then harvest the materials you find on a site and build with that.
The reusable print material is a mix of biopolymer made from recycled plastic or plants like corn and sugarcane, and basalt, a rock found on Mars and Earth.
It's the rock that gives us its incredible strength. We've tested this material. It's 3 times as strong as concrete in compression, and it actually has what we call a tensile capacity, prevent itself from being pulled apart, which is something concrete's not very good at. You need to think at all times, how do you optimize the amount of material that you use? And that's also why this thing is shaped like an egg. And if you think of an egg, it's a very structurally optimized form. It's very, very thin, but it provides the strength that the egg needs. And that's why this is shaped the way that it is.
The egg shape, as well as the nested shell structure, also accommodates for extreme differences in pressure and temperature on the surface of Mars. But more research still needs to be done to find out how print materials could be gathered and how 3D printing would work in a unique environment of space.
You're dealing with a completely different set of physics and environments, which is very harsh. The cold, the low gravity, the vacuum of space, and finding solutions for how to build there or do anything in space just requires a high degree of innovation. There's no such thing as brute force when it comes to space. Like, you need to think about the problem, find a very elegant, lightweight, cost-effective solution. The next challenge is really going to places on Earth, literally taking the dirt that we're finding on a site and beginning to print with the dirt. We have to perfect this technology on Earth, and then we go prove it out on the Moon, and then finally onto Mars.
The first customers could include NASA and companies like SpaceX, who would lease out these structures for individual missions. But before that, AI Space Factory hoped their technology could be monetized as well as transformational here on Earth.
The challenges of building on Mars forced us to kind of make this jump in construction technology, which we can now apply on Earth, to build more sustainably. So rather than building with steel and concrete, which are these manufactured, very energy-intensive materials, to go to a site, have a solar-powered array that would then allow our 3D printer to print in the most sustainable way possible. And we never would have found these ways if it wasn't for the challenge of building in space.
3, 2, 1, ignition and liftoff of the Falcon 9 to the space station on the first commercial launch from Kennedy Space Center's historic Pad 39A.
That's part of our special Bloomberg original series called Giant Leap. You can check out more on Bloomberg.com. And that does it for this edition of Bloomberg Technology. We are live streaming on Twitter. Check us out at Technology. And be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.